Are you new to investing and feeling overwhelmed by all the jargon? You're not alone. For many beginners, diving into the world of investing can seem like learning a whole new language. But what if I told you there are just a few key terms that, once you understand, will completely change how you approach investing? In today's video, we'll break down the top 5 simple investing terms that every beginner should know. Understanding these will give you the confidence to get started and make smarter decisions with your money. Let's dive in. 1. Stock. Let's start with one of the most basic yet crucial terms. Stock. At its core, a stock represents ownership in a company. When you buy a stock, you're essentially buying a small piece of that company. Think of it like owning a slice of a pizza. The bigger the company grows, the more valuable that slice becomes. Stocks can give you a say in how a company is run, especially if you're an investor in larger companies with voting rights. But more than that, owning stocks means you're entitled to a portion of the company's profits, usually in the form of dividends. So, if you're considering investing in individual companies, buying stocks is one of the best ways to start growing your wealth. Stocks are one of the most accessible forms of investment because you can buy shares in companies with as little as a few dollars. However, stock prices can fluctuate due to many factors, such as company performance, market conditions, and even global events. So it's important to keep this in mind when you decide to invest. Over time, stocks can grow in value, and you can benefit from capital appreciation or income through dividends. Understanding stocks helps you grasp the foundation of investing. It's one of the primary building blocks for anyone interested in the world of finance. This is why many investors consider stocks a core part of their investment portfolio. 2. Dividend. Next up, let's talk about dividends. A dividend is a portion of a company's profits paid out to shareholders, usually on a quarterly basis. Imagine you own 10 shares of a company, and they declare a $2 dividend per share. That means you'll earn $20 just for holding onto your stocks. Dividends are one of the ways investors earn income from stocks without having to sell them. For beginners, dividends are a great way to create a passive income stream. Rather than relying solely on stock price appreciation, which can fluctuate, dividends offer a more predictable source of returns. Over time, reinvesting these dividends can help you build even more wealth, a strategy known as dividend reinvestment. By reinvesting, you buy more shares of the company, allowing you to benefit from compound growth. Dividends are especially appealing to investors who want regular income from their investments without having to sell their shares. For long-term investors, the beauty of dividends is that they provide an opportunity to grow your wealth without actively trading. As companies grow and their earnings increase, dividends can also grow, giving you more income over time. 3. ETF. Exchange Traded Fund. Let's move on to another important term, ETF or Exchange Traded Fund. An ETF is a collection of assets like stocks, bonds, or commodities that you can buy or sell just like an individual stock. Instead of picking a single stock to invest in, an ETF allows you to invest in a whole basket of them, providing instant diversification. This makes ETFs an excellent choice for beginners who want to spread their risk without having to pick individual stocks. It's like creating a mini portfolio with just one investment. ETFs are also generally more cost-effective because they have lower fees compared to mutual funds, making them a great starting point for new investors. The beauty of ETFs is that they allow you to invest in a variety of sectors, industries, or even regions without requiring a large amount of capital. Unlike mutual funds, which are priced once a day, ETFs trade on exchanges throughout the day just like stocks. This gives you the flexibility to buy and sell shares at any time during market hours. Plus, many ETFs track popular market indexes like the S&P 500, so you can invest in the broader market with one simple move. So, if you're looking to diversify without doing all the heavy lifting, an ETF might be your best bet. They offer you an affordable and simple way to start building your investment portfolio. 4. Mutual fund. Now, let's talk about mutual funds. A mutual fund is a pool of money collected from many investors to buy a diversified portfolio of stocks, bonds, or other securities. Unlike ETFs, which are traded on the stock market, mutual funds are typically bought or sold at the end of the trading day based on their net asset value. The advantage of mutual funds is that you're getting professional management of your money. It's ideal for beginners who might not feel confident picking stocks themselves. The downside, however, is that mutual funds usually come with higher fees because you're paying for that professional management. Still, for those looking for a hands-off approach, mutual funds provide a simple way to invest in a diversified portfolio. Mutual funds can range from stock-focused funds to bond funds to balanced funds that mix both. They also allow for easy diversification since a single mutual fund might hold dozens, if not hundreds, of individual securities. By pooling money from multiple investors, mutual funds give you access to a wide range of assets that would be difficult to replicate on your own. Mutual funds can be an excellent way to grow your wealth, especially if you're just starting out and prefer not to take on too much risk by choosing individual stocks. However, be mindful of the fees and ensure you're selecting funds that align with your investment goals and risk tolerance. 5. Index fund. Last but not least, let's talk about index funds. An index fund is a type of mutual fund or ETF designed to replicate the performance of a specific market index, like the S&P 500. Essentially, these funds invest in the same companies that are in the index. For example, if you're investing in an S&P 500 index fund, you're indirectly investing in the top 500 companies in the US. What makes index funds so attractive is their simplicity and low cost. Because they are passively managed, meaning no fund manager is making active decisions, they tend to have very low fees compared to other investment options. Index funds are a fantastic option for beginners who want to invest in the broader market without the need to research individual stocks. In addition to their low fees, index funds are typically a good long-term investment choice. Historically, they have delivered solid returns because they track the overall market, which tends to grow over time. This makes them perfect for people who want to invest without constantly worrying about short-term market movements. If you're in it for the long haul and want a solid, low-maintenance investment, an index fund could be exactly what you need. By investing in a broad market index fund, you can be confident that you're investing in a diversified portfolio that reflects the overall economy's growth. So, now that you understand the basic terms like stocks, dividends, ETFs, mutual funds, and index funds, you're ready to start building your investment strategy. Don't be intimidated by the world of finance. Just take it one step at a time, and you'll gradually become more comfortable. Remember, these terms are only the beginning, and there's always more to learn as you go along. The key is to start somewhere. If you found this video helpful, don't forget to hit that like button, share it with anyone who might be interested, and subscribe to the channel for more tips on building your investment knowledge and growing your wealth. See you in the next video.